Welcome. On the show today, we're speaking to anthracite miner Petman. I'm Nozi Pombanjwa, and this is Resource One. Let's kick off with the market wrap for this week.
South Africa's Mines Minister Nwako Ramatlhodi is worried about the rate at which mines are cutting jobs. He's met with unions and the companies concerned. Thousands of workers face retrenchment in gold and platinum mines, which are battling cost constraints amid weak resource prices. Meanwhile, wage talks set to start in the gold sector look set to be tough. The Association of Mine Workers and Construction Union AMCU wants workers earning 6,000 rand a month to get 12,500. And it's reported that majority union NUM could ask for as much as 80% hikes. And a new Thomson Reuters report says platinum prices could test $1,000 an ounce this year, a level not seen since early 2009. This as supply from South African mines and global auto catalyst recyclers increase.
Now, Petman is a dividend-paying, cash-generating mid-tier miner listed in Johannesburg. Its operations are based in South Africa, and it has exploration projects in Canada, Liberia, and in Turkey. I'm now joined by Bradley Doig. He is the Business Development Director at Petman. Bradley, thank you for making the time to join us. It's certainly a first for us having you on Resource Watch, so welcome. But maybe let's start off with getting a sense of what does Petman do? Where is your operational focus, and where are you in the commodity space?
Okay. Petman, with the Petman in its current form, started about 10 years ago. We acquired the largest silica mine in the country, turned that around, made a really good return on that. So essentially that was our focus as a team. We then ended up buying a suite of anthracite assets, including what was now the Spring Lake Colliery. It's an old operating colliery together with a project called Somkhele. On acquisition, we got stuck into Spring Lake, turned that around, eventually sold that, and we used a lot of the self-generated capital to develop Somkhele, which is today South Africa's largest anthracite miner. We produce 1.2 million tonnes of anthracite and about 400,000 tonnes of rewash discard, which is a product that goes into the energy market or goes into things like cement kilns around the world.
Let's take a couple of steps back, because I know for one myself, I'm not quite sure what anthracite actually is. So for our viewers, if you can expand on what that commodity actually is.
Absolutely. Anthracite is a very high-ranking coal, so it means it's got a high carbon content, and it's ideally used in metallurgical smelting processes like ferrochrome smelting, ilmenite smelting, sometimes in manganese smelting. So it's a replacement for coke, essentially, a low-cost, energy-efficient replacement for coke in many of those processes. It's in addition used for pelletizing of iron ore fines, particularly in Brazil. So we have, so our market is essentially our local market is essentially the ferroalloy industry here. And then we have a big market in Brazil to the iron ore smelters there. It
certainly sounds like a niche market. Maybe give us a sense as well as the mining methods that you employ, and also just the supply and demand dynamics for anthracite.
Yeah. Look, I mean, we're very fortunate. We have an open pit mining structure at Somkhele. So our mining costs are slightly different. Most anthracite is underground mining in South Africa. Very tricky, low seam, drill and blast operations. And then, I mean, you can read about many difficulties. I mean, we had a lot of experience with Spring Lake, which is an underground mine. But we're an open pit mine at Somkhele and running at about a 3-to-1 strip ratio overall. So obviously from a cost perspective, we are competitive. We're also only 75 km from Richards Bay. So we've got a really good logistics benefit going to the port. And most of our customers that are ferrochrome producers, they take their product to Richards Bay and they come back with empty trucks. So they pick their product up. So we have an inbuilt logistics advantage with our local customers as well. Essentially that's essentially in a nutshell where we are.
So I know you've made mention of the Brazilian market, which is a key focus for you, but what about the geopolitical tensions? Let's talk about Ukraine, bringing that into the picture and how that also influences the business.
We've been, right now we're in a fortunate position. Over the last sort of 3 to 4 years, you've seen a convergence in pricing. Low vol PCI, API 4, bituminous coal, anthracite, export anthracite, all coming together in terms of pricing. So particularly low prices. What's happened recently is because of the Ukrainian crisis, there's been a dearth of anthracite supply into Brazil and to other areas. So there's been demand for South African anthracite, particularly ours. So we've seen a spike in our a short-term spike in our pricing. We're trading at about a 40% premium to API 4 at the moment, which is obviously very pleasing to us. And we, looking at the Ukrainian situation, and spoken to guys in the Ukraine, we don't see that Ukrainian production coming back very quickly, simply because the infrastructure has been damaged quite badly.
So that positivity is likely to stay for a little while longer for you. I mean, also picking up on some of the reportage around Pettman, we also see that your market cap has grown exponentially in the last 5 years. What kind of room and financial muscle does this give you? And in particular, the question really comes down to your acquisitive pipeline. What does that look like?
Yeah. Look, we're strongly cash generative, so we have cash available. While gearing is around 29%, we'd like to take that down a little bit, around about to 25. But we have firepower for acquisitions, but we've done a lot of work on a lot of potential acquisitions, and particularly in South Africa. And we found that the value's just not there at the moment. So we've looked at things, we've done deep dive due diligences. In reality, with our cash, we looked at our share price, we looked at the business that we know and love and understand, have been with for 10 years, and we did a share buyback. And we're going to continue to buy shares back because we believe we're completely undervalued at this particular point. Having said that, looking further afield abroad, we did go into exploration activities in Liberia and Turkey.
Yeah.
We've closed those down. That's a function of, one, obviously the ore bodies didn't stack up, and two, the current commodity environment just doesn't back long-term exploration plays. Our focus is on things that we can turn around or things that we can bring into production within 18 months.
Let's take a couple of steps back, because there was a reaction to the share buybacks, and in particular to increasing that scope, if I've got my numbers right, between 3 to say 5% possibly. How are you communicating to the investment community to allay their fears? Because there's lots of perceptions that are attached to share buybacks.
Absolutely. I mean, we have cash, so cash, we need a return on that cash. So our view is that we can either invest in a new project and take the risk associated with that, or we can buy back our own shares and get better, or probably even better and more lower risk returns by doing the share buybacks. That's all it is. So we're just backing ourselves again in this process. I mean, you pay dividends or you do share buybacks. Net, the shareholders are better off,
right,
as far as we're concerned. And we haven't. There's been a disconnect between I suppose resource businesses with long-term capital plans and short-term investment horizons.
Yeah.
Okay, and we're just trying to make sure that we can ride this commodity decline at the moment by doing the right things. And doing the right things is keeping the balance sheet tidy, buying our shares back and growing the existing business.
Let's talk a little bit about the demerger, and this is of course out of North Atlantic and a possible relisting, if I've got that research right. Let's talk about the rationale behind that, and also the timing, given the commodity cycle. Does it make better sense to do it now because there's potential for further upside if you're demerging now? Give us some insight there.
Well, I mean, our strategy was to look around the world where we could make an impact. And I mean, essentially, we're backing the reindustrialization of the United States long term, and that's predicated on very cheap energy prices, gas prices, electricity prices. So we're developing a metallics business, which is essentially a pig iron business. So we take low-grade feedstocks and we convert them to high-grade pig iron, which is an essential feedstock in manufacturing of steel in electric arc furnaces. And most of the steel manufacturers in the US and Canada are electric arc furnace based. They're not blast furnaces. So we've been working on this for 4 years now. It's been a long process. We've identified 2 sites that we are currently evaluating. We're down to the final 2 sites. We're doing a feasibility analysis on each of those sites to determine which is going to be the best site, both from a logistics and cost-based perspective, but also from a fiscal incentive perspective. The Canadian government, particularly the Quebec government, are well known for providing fiscal incentives for new initiatives like this one. So we're busy doing that work at this stage. In terms of the timing of the unbundling, I mean, we believe we don't get any value right now in our share price for the NIC investment that we've made. But it's potentially a very lucrative business. So what we're going to do is we're going to finish the site selection process, we'll finish the feasibility study, and then we are still committed to unbundling it, but the timing is going to be subject to the completion of this work, which is, the delays are normal project delays. There's nothing sinister about any of the delays at all.
Final question, Brad, before I let you go. Let's just take a look at the emerging markets forecast. You've got your foot in South Africa, you've got exposure in Turkey, you've got a play in Brazil as well. And we also know the macroeconomic environment, in particular the monetary policy environment in the US, is going to have a big knock-on effect on sentiment for emerging markets. When you're looking at the global macroeconomics, where does the the pressure come on for you, or do you see opportunity in the way things are playing out right now?
No, I mean, I think in any declining market, there's a catharsis in the industry. And I mean, for us, that's an opportunity. We've lived through probably one of the most difficult commodity cycles. We maintained our balance sheet integrity. We've got cash available. So we're looking. I mean, there's always an opportunity globally. I mean, look, you can look at macroeconomic factors affecting China, affecting the US. There are many things that influence a business decision. But for us, if you bull commodity, you bull commodity. So because you're in a decline for 2 or 3 years, I mean, we see the pricing soft for the next 2 to 3 years. It's tough times. So get your costs under control, but stick to your guns. If you've got a good operating methodology, you'll find the right assets to invest in, and you'll take it from there.
Bradley, thank you so much for your time. That's Bradley Doig. He's the Business Development Director at Petmin. And of course, telling us there that it may be tough for now, but if you stick through the cycle, there is some upside to be realized. And here's our gem of the week.
Gemstones, or crystals, are formed in many environments of the earth. Water interacts with minerals and dissolves them, and these stones form over millions of years. They are then mined, polished, and made into a variety of ornamental items, including jewelry. These stones come from the Mapatiza mine, located in Zambia.
50–60% of a replica, because you can't really make a mine, but it's a replica mine from our amethyst in Kalomo. And they're going into those chambers, and then they hear the story, where we find it, how we find it, how difficult it is, because Mapatiza means hard work, hardship. And in our Mapatiza mine, only ladies work. Mostly 90% ladies, and the men are doing the trucking and with the cars, but the ladies are doing the digging.
Gemstones are classified into different groups, species, and varieties. For example, ruby is the red variety of the species corundum, while any other color of corundum is considered sapphire. Amethyst is prevalent in most places in Zambia, but major production is in the Mapatiza area. Annual production of amethyst is about 700 tons, and it grows in a carpet-like form underground. Crystals have been used for energetic cleansing, balancing, protecting, and healing purposes for thousands of years.
You see, the gemstones, they can be used in jewelry, in decorations, in walls, in floors, in tiling, or you can do carvings or healing purposes, which is very, very good to have a gemstone in the company, in your house, because it is good for the amethyst for drunkenness, the crystal for healing purposes, the black tourmaline to keep the evil away, the rose quartz for love, and so on and so on. There's so many. Fluorite, which everybody knows, is made with a beautiful stone, but it is made also in toothpaste. You grind it down in toothpaste.
Whether you use them for decoration, healing, or even swimming, these ancient stones capture the imagination.
For this week's show, do stay in touch. That's by following me on Twitter at @TheRealNoze. Don't forget, the hashtag for our show is ResourceWatch. Until next time, it's goodbye for now.